My next guest making huge waves in education, educating the masses on what money really is and where money is really going. Joining me now, Lynn Alden, investment strategy founder, Lynn Alden. And Lynn, I got to be honest, I had no idea. I felt like it was all contained. You had these unique situations, which is two banks. I didn't know there were 22 runs on banks. So I'm curious now as to what the health of the banking sector might be at this very moment.
So I think it's improving now compared to where it was a year ago, but it's certainly not out of the woods yet. I think basically whenever interest rates are raised by this much, this quickly, especially from such a low base, that is at risk of breaking things. I think the bigger picture is less about the probability of, say, bank runs in the intermediate future. It's really about the Fed's overall ability to fight inflation, because ever since we saw some of these banking issues a year ago, the Fed has kind of wavered on their inflation fighting mandate. As was previously discussed, more liquidity in the form of loans and various facilities was put into the system. Even as they were trying to fight inflation, we've also seen a slowdown in the number of rate increases and the unwillingness to raise rates, even though we still have above target inflation. And this is because, in large part, I would argue that the policymakers are very careful to do something that either disrupts the sovereign bond market or disrupts the banking system in any sort of acute way.
So to that point, there's been quantitative tightening, but even there, they've altered that somewhat, right? And so a lot of folks are saying maybe with respect to Fed policy and whether it's been restrictive enough, how could it ever be restrictive when the fact of the matter is the liquidity never really went away?
Yeah, pretty much. During 2022, we saw falling liquidity, which was disinflationary. But ever since 2023, we've been in more of a sideways liquidity situation. And the New York Fed's already projecting in some of their reports that by next year, 2025, they're likely going to go back to balance sheet increases. And so I think it's somewhat probable that some of these loan facilities will only be wound down once the Fed is back to gradual balance sheet increases. And so you still have a sideways to higher liquidity situation, even though they're ostensibly trying to fight inflation. And so if you had a lower debt, more stable banking system, less debt and deficits on the public level, then it'd be easier for the Fed to do whatever it takes to fight inflation. But because they have these other constraints, it kind of handcuffs them to a certain extent in terms of the tools that they can deploy and the speed and magnitude when trying to fight inflation. So you risk getting stuck in kind of a what Jamie Dimon referred to as a stagflationary potential.
I want to ask you about two things. Now, I remember back in early 2009. The market felt like it was in permanent free fall, perpetual free fall. Of course, in March, we hit a bottom. But a lot of people did not get into the market because the overall narrative on Wall Street amongst most of the analysts was that the next shoe to drop would be commercial real estate. And we've been hearing that, of course, here more recently as well. How big of a threat is that, not just to the banking sector, but to the overall economy?
So for the broader economy, I would say moderate, because, for example, even if there's, say, $1 trillion or $2 trillion losses in commercial real estate, that sounds very big. But compared to, for example, there's like $2 trillion in annual fiscal deficits, for example. There's well over $140 trillion in estimated U.S. household wealth, for example. Mm-hmm. And so those are, I would describe those as more local issues to the banking system and to the commercial real estate developers themselves.
I got 30 seconds. Your main newsletter, it's titled "The Bond Market is the Dumb Money Now." What does that mean?
So basically, the larger that a sovereign bond market gets relative to the size of the economy, the more it is likely to be a managed market. So there's central bank buyers, there's treasury actions. And so basically the point there is that the bond market is less informative on the state of the economy or forward inflation than it used to be in the golden era of the bond market back in the 80s and the 90s.
All right. Lynn, great stuff. Always appreciate it.